Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. Today we'll talk about how Social Security benefits are taxed and how much money you might want to consider having in your emergency savings. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined with Ryan Connor and Ryan Pekka of Buska Retirement Solutions and Buska Wealth Management. And in this segment, we're talking about something that's essential for many retirees, and that is how Social Security benefits are taxed and what you can do about it. Gentlemen, thanks for joining me today.
Of course.
So Social Security is a benefit that most of us get, but unfortunately even that is taxed. So how are Social Security benefits taxed, and how are they taxed?
Sure. Social Security taxes in the state of Wisconsin are not taxed by the state, but they are taxed on a federal level. How much you pay in taxes really depends on kind of other incomes. If Social Security is your only source of income between you or between you and your spouse, typically you're going to fall underneath that range, but most people live on more than that. So as we collect other benefits, if you're pulling from your IRAs, you have another account that's gaining interest, things like that will be factored in. And then another big factor is some people continue to work maybe just part-time in retirement, and those will affect your benefits as well. And then there's also a limit on how much money you can make before that starts affecting your Social Security benefit as a whole.
Okay, because you say income, but I'm not working anymore, but you mentioned these other things. What other types of things will make me look like I have income when I quit working?
Yeah, well, in some cases, some folks, like Ryan talked about, haven't quit working. And so if you're working part-time, or if you've reached full retirement age and you're still working full-time and you're kind of what I call double dipping, taking Social Security and working full-time, that will definitely impact the income. But even if you're retired, there are going to be a lot of income sources that will still count into figuring out how much of your Social Security is going to be taxable. Any distributions or withdrawals that you receive from pre-tax retirement accounts will be considered. Any interest that you have will be considered, whether it is taxable or even non-taxable interest. Something like municipal bonds are typically going to be non-taxable, but they count in this specific case. Any gains you have from like a capital gains department. So if you have a non-qualified investment account and you've got gains that you sell, that's going to factor in as well. So even though you're retired, there are still going to be things that count, especially if your former employer offered a pension plan, at which point that income is all going to count on a dollar-for-dollar basis. And so just because you're not working doesn't mean you don't still have income.
Well, it's probably a good thing.
Yes.
Now, let's talk about the percentage of Social Security tax. I saw some bullet point or something the other day that said 86% of the Social Security benefit up to can be taxed. They can take up to 86% of the benefit?
So it's not exactly how that works.
I mean tax. That's a take? Tax.
So they can tax up to 85% for the highest earners. There's a range, so most people fall into the 50%. Higher earners
Tax up to, not take up to. 86%.
Correct. They're going to tax you at your standard tax rates, which are also applied based on different dollar amounts and kind of tiered. So not all of it's taxed. If you fall into the 22% tax bracket, it's really those last dollars that are taxed at that amount. So most people aren't paying the full amount on their Social Security benefit. At worst, you have 85% of that benefit is taxable at those tax rates. Most people don't fall into that category if they're on the lower end of income, and you can actually fall into 0% tax on Social Security if you're on the very low end of that income scale.
Yeah, it's one of the things I like to talk to about clients when they're very concerned about Social Security taxability is that the absolute worst case scenario for them is that they're still going to get 15% of it untaxed at the federal level. And in the state of Wisconsin, like Ryan said, the state of Wisconsin does not tax Social Security benefits. But like you talked about, there's a very wide scale. So Social Security taxability does not have super neat brackets like our income tax system does. So as you progressively have more what's called provisional income, which I'm sure we'll get into later, the amount of your Social Security benefit that is taxable increases. And so you can have a situation where, let's say, half of your benefit is taxable. That doesn't mean that it's going to be taxed at a 50% rate. It just I
don't lose half of it.
Exactly.
Okay,
exactly.
That's good.
It just means that half of your Social Security benefit will be added to your other forms of taxable income when it comes time to calculate what your taxable income is for that year, including all your various different sources.
All right, that makes more sense. So if Social Security is taxed and I have the Social Security payment coming in and it's me and my wife or whatever, and how does all that play into controlling that amount, but also like I got these other retirement accounts that are giving me money hopefully over here. How does all this come together?
Yeah, so it's going to be, something that you really do want to plan out, not only in the short term, because like what you're talking about is like, how do I make sure I'm just good and paying the right amount of taxes, right now, or trying to at least minimize the amount of taxes I'm going to pay right now. What we actually want to do is extend that timeline out over the course of your retirement. Because in a lot of cases, like if you have a pre-tax retirement account, and you're just, I'm not going to make withdrawals from that because I don't want to increase my Social Security taxability. Well, there are some laws that involve required minimum distributions from pre-tax retirement accounts, so your traditional IRAs, most of your 401k dollars for most folks, 403bs, deferred comps, and the like, that at certain ages, depending on when you were born, right now for folks at 73, for some folks watching it may end up being 75 for them, it all depends on when you were born, they're going to have to start making withdrawals. And if they don't make any withdrawals for, let's say, like a decade, and then they have to start withdrawing a certain percentage, well, that percentage is going to be higher. And so they might go from a situation where they're not taking much hit on taxes from Social Security for maybe 4 or 5 years, and then all of a sudden they're paying that full 85% of it into their taxable income portion. So what we want to do from a planning perspective is actually map out some different scenarios to see how can we keep this from becoming a problem long term. If it can be managed. In some cases, because of your income levels, because maybe if you've got a large pension, there's not a lot of maneuvering we can do to reduce it. But in a lot of cases, especially as pensions become, less and less common for retirees, you might have some more wiggle room to kind of, figure out how to reduce the overall tax load on your Social Security over the course of your retirement.
Got it. So you can't look at it in a vacuum and say, if I do X today, it creates Y today because I might be causing disaster later on.
Correct. Your financial advisor can help guide you through those kind of thoughts and processes. Things like Roth conversions earlier on in retirement might be able to help with some of those things where you don't have RMDs on a Roth account. So working with them to develop a long-term plan makes a lot of sense. People view retirement as kind of this end goal, but really it's the start of this new phase of your life. 20 to 30 years of your life are going to be spent in retirement, so you can't look at it year by year. It's a 20 to 30 year process, and you should have a tax strategy and a strategy as a whole throughout that process, and Social Security is a piece of that. But your advisor is going to help work all those other pieces and make it more of a concrete picture for you.
How do you put all this together for a person to understand?
Well, the nice part is the reports that we're able to run is able to help break things down where it's going to feed in, the Social Security information is going to give us a layout of all of the different tax types of investment accounts that you may have. And then what we're able to do is run a variety of different scenarios, testing out the longer term impacts of that.
Got it.
So it's not just like, general, guidance or rules of thumb. For every individual situation, you're going to probably need a different strategy.
Makes perfect sense. Let's take a break, and then we're going to continue our examination of how proactive tax planning can help preserve more of your retirement income and why Social Security should be a part of your broader tax strategy. Stay with us.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with Estate Guru, we make estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
And now back to our weekly question and answer segment.
During our time together today, we've been considering the tax side of Social Security, the details of which often surprises a lot of retirees. And before the break, Ryan and Ryan explained how your overall income can impact how much your benefit is taxed. So let's talk a little bit about this further. You mentioned provisional income. So how does my provisional income, and what is provisional income, affect the taxability of my Social Security?
Yeah, so this is one of the many weird things regarding Social Security taxability that a lot of folks don't just immediately understand, because it's something that you never run into until you start taking Social Security. So first, what is provisional income? So the calculation for provisional income is going to be half of your Social Security benefit. So if your Social Security benefit, let's just say for your household, is $50,000 a year, it's going to count as $25,000 for the purposes of this calculation. Then on top of that, you add on all of your taxable income from other sources. So whether that is a pension, whether those are 401k withdrawals, whether those are capital gains that you are taking on, whether it's, rent you're charging if you own properties, whatever other sources of, normal income you would have. Now, the thing that they add on top of this is non-taxable interest. And people see that in the calculation, they go, what does that mean? Most interest is going to be taxable. What that is pretty specifically targeting is going to be interest income on municipal bonds, which is typically not taxable at the federal level, but for the purposes of the provisional income calculation is considered.
Well, that's a nice feature.
Yeah, everybody loves that. And so what that will do is, depending on what number your provisional income is, that then will dictate what portion of your Social Security is going to be subject to income tax. And unfortunately, Social Security is not a nice, neat bracket system.
Yep.
It's basically a sliding scale where as your provisional income increases past a certain threshold, the taxability of your Social Security increases as well until it reaches that peak that we talked about in the first segment of 85% taxability. And so provisional income, the whole kind of calculation of figuring out what your taxability is going to be, is not super straightforward to just, here, look at a tax bracket chart. You can figure it out from there. It's a sliding scale that we actually utilize calculators to figure out.
Okay. So it's a complicated thing, like most things. Now, I remember talking about this one in a health insurance segment we did too, of you say my income can cause increases to premiums, but again, we talk about income, lowering or increased Social Security taxation, but I don't have income, I just quit. He named a couple other sources of 401ks. Why does a 401k, how does that have to do with income?
Sure. So when you look at your retirement accounts, especially 401ks, traditional IRAs, a lot of times you get that tax break up front. So you're not paying taxes on those dollars as you're working throughout your career, things like that. That's one of those benefits. For a lot of people, it can drop you into a lower tax bracket or just mean you're paying less tax dollars overall during that year while you're saving for retirement. Really, the government looks at this as an incentive to get you to kind of make sure you're stable in retirement. You don't have to rely on Social Security alone. And so in return for that, they say, hey, we're going to let that grow kind of tax-free. But now when you take those withdrawals, Uncle Sam says they want their cut at that point in time.
Shocker.
Yeah, I know we're all surprised that they want some tax dollars from us at some point. So that's really the biggest thing, is we haven't paid any taxes on it yet. So they view that as income later in life. It's kind of the same as your pension plan. You're no longer working, but you're making income now. It just looks a little bit different than it used to. You don't have to go to your 9 to 5 or bartend at night to get your income anymore. It's just a little bit different for you at this point in time.
Okay, makes sense. Now, that's IRAs, 401ks, Roth IRAs. Roth IRAs are non-taxable to my knowledge, or do they have that fun thing that the muni bonds have where they throw it onto this one?
So they don't.
Okay.
So, and the reason they don't is because, Ryan talked about how, with the traditional IRA, any sort of pre-tax retirement, so traditional IRA, most 401k or 403b dollars, you get that deduction up front. And so when you get that deduction up front and it gets to grow tax deferred, so they don't tax it while it's growing, but when you make a withdrawal, then they tax it as income. With Roth, it's basically flipped around the other way. So you don't get a deduction up front. So you are putting after-tax dollars into the Roth. It gets to grow without you paying taxes on it. And then when you withdraw the funds later, because you've already paid taxes on them and have followed some rules that are required with Roth IRAs, like can't take it till 59 and a half, can't take earnings out on money you contributed within the last 5 years, then it's treated as non-taxable. So it does not count towards your provisional income. So if we're looking at ways to possibly reduce the taxability of your Social Security, Roth IRA income, which doesn't count as income for the purposes of the provisional income calculation or your tax calculations can be an effective way to do that over the course of your retirement.
Now, all this sounds confusing. We were talking during the break, and you mentioned you have a Social Security maximization report where you could actually spell this out to somebody. How does that work?
Sure. So when we look at Social Security maximization, it's really looking at Social Security on its own. So it's beneficial in that sense where we can look at here's exactly for your specific, you or you as a couple, how it specifically would be the most beneficial to you. As advisors, we use that as kind of a starting point, but it's not always what we're going to recommend. Social Security, your income, all of those things can change pretty rapidly over time, especially in retirement. Nothing's necessarily guaranteed. We can make a lot of projections and guesses and things like that. But as far as we use that, it's a useful tool. It projects it out kind of what the possible outcomes are and how you could maximize it. If you're looking at it on its own, what's the best dollar amount we're going to put in our pocket if we're looking at nothing besides Social Security. As your advisor, we're always going to couple that with your outside plan. So if you're going to need to take 401k withdrawals to meet your income goals or take funds from other places, we're always going to look at that and say, hey, Social Security makes sense. We always want the most dollars out we can, right? So the government taxes us. We want as much of that money back as we can in the form of Social Security at the end of the day. But it doesn't always make the most sense to say wait till 70.
Sure.
So when we're looking at those things, we're always going to balance that between kind of best dollar amount and what works best with your individual plan.
One of the parts about the maximization report that I really like to show clients is there's a really handy chart in there about what is going to be the best benefit for your lifetime benefits, depending on the age at which you pass away. And that can be really important for clients who might have major health issues, or if we just run normal life expectancy, it'll give us one answer. But if someone knows they have a particular condition that's going to reduce their average life expectancy for them, then we might actually want to execute a different strategy to likely maximize it once we factor in some of those health conditions, which, unfortunately, that can be part of the circumstances for folks.
Good. And how does one get the report? Do they have to be a client of yours and call the office? Like, how do you get one?
Yep. So that's going to be part of our
asking for a friend.
Yeah. So that's going to be part of our consultation process, which is no cost, no obligation. Folks come in, go through our process. One of the reports that we'll run, if they have not already filed for Social Security, because once you've kind of started that, you're not really going to turn it off. We will run the Social Security maximization report as part of it and incorporate that into a more comprehensive income plan.
Great. Well, I appreciate you guys coming on. I mean, Social Security is a big part of most people's retirement, and it's, best of all, it's the money you put in. So it's nice to get that back.
That's right.
Thank you very much for joining me today, gentlemen.
Thank you.
With that, we're going to take a quick break, and we'll be right back for Financially Speaking.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we create personalized comprehensive retirement plans by integrating investment management, income planning, tax strategies, estate planning, as well as health insurance and Medicare planning, all under one roof. Call today or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation or to get a second opinion review of your current plan. Let's make retirement planning easier together.
And now, our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management. And joining me this week is Ryan Pekka. Today, Ryan and I are going to discuss emergency savings.
That's right. Investopedia laid out a prescription for how much we should all have in an emergency saving in an article titled, "Your Emergency Fund Should Be $35,000. Here's Why."
Ryan, I'm sure some of our viewers are thinking, wow, $35,000 is a lot of money. I don't know if I can reach that target.
It is a lot of money, but I encourage viewers to take a deep breath. In my opinion, the worst thing you can do is say to yourself, I'll never be able to save that much, and just throw your hands up.
That's certainly a great point. Sometimes people get overwhelmed by a big goal and just get intimidated to the point where they don't even try. If there's one thing that you take away from this segment, viewers, it's that even if you can't get to 35,000, you can still try.
So Yoda was wrong?
Yoda?
In The Empire Strikes Back, Yoda says to Luke Skywalker, do or do not. There is no try.
Well, Yoda wasn't a financial advisor.
That's a good point, Cole. All right, let's dive into the article. Investopedia says we should all have $35,000 in emergency savings. Why?
Well, first, the article acknowledges that this number is higher than other recommended emergency fund figures that are often cited.
So how did Investopedia come up with this figure?
Well, most financial professionals advise people to have 6 months worth of expenses saved. That equates to 40% of the average U.S. household's income, which according to Census Bureau data is $35,000.
Sounds like a reasonable calculation to me. So what are emergency funds for?
Well, you build emergency reserves so that you can cover a range of unexpected costs. Car repairs, home repairs, if a pipe bursts. You want to be able to cover the cost of a plumber without having to scrape or put it on a credit card.
Sure. What about if you lose your job or health insurance?
Well, that's another reason to have a healthy emergency fund, and it's why experts use 6 months worth of expenses as a rule of thumb. If you lose your job, you'll have something to cover expenses until you can find a new one.
How much does 6 months worth of housing, food, utilities, healthcare, and transportation cost for 2 people?
Well, Investopedia calculated that those things cost around $35,217.73. It's more than in previous years and a lot more than most folks have saved.
I want our viewers to remember that while it may sound like a lot, having this amount saved can prevent you from having to pay for unexpected expenses with credit cards, which can lead you into serious debt.
That's right. A heavy debt load can be hard to get out from under. It could be helpful to think of saving money as an investment. You're investing for the goal of a debt-free future.
I love that. So let's break it down. What do each of these various expenses cost on average?
Investopedia estimated that medical care is the biggest expense, comprising $11,635. Next is car costs, which are around $10,621. Housing and utilities ring in at $9,785, and food is about $3,176.
I wonder if it helps people to save money if they think of it in smaller chunks. For example, if I save $3,000, I can eat for 6 months. And then they work toward that goal. And once they hit that target, they start thinking about the next one. If I save $9,000, I can pay rent for 6 months.
That sounds like a great idea. Now, the Federal Reserve did a survey in 2022, and it showed that people were more willing to dip into savings to cover emergency costs than they were to cut costs, work more, or borrow money.
That's all the more reason to have a robust emergency fund. If you don't want to cut costs, work more, or borrow money, having money saved is about the only alternative there is.
That's right.
What if I look at the costs you listed earlier and mine are lower? Do I really need $35,000?
Well, you can take a look at your expenses and come up with a number that will suffice for your particular situation. However, you need to make sure you consider all of your costs. How much are you spending right now on rent or mortgage payments, utilities, food, transportation, medical costs? Add all of those up. The number that you get is what you should strive to save.
So if that number is less than $35,000, I don't have to save quite as much?
Yes, and conversely, if your number is higher, you'll have to save more. I will add that even if your 6 months worth of expenses is less than $35,000, it wouldn't hurt to try to hit that number anyway if you can.
That makes sense to me. What about choosing a place to keep your emergency fund? What kind of account should our viewers save money in?
Well, you can put it in a regular savings account, but if you can put it into a high yield savings account or money market account, it could make reaching your savings goal a little easier.
Sure. If the bank pays you interest on your account, then the amount you deposit into it every month increases.
That's right. You also want this account to be liquid because you need to be able to take money out when you have an emergency expense.
Absolutely. What if some of our viewers aren't accustomed to saving money? How should they get started?
Well, first of all, I'd like our viewers to know that you can start saving now. It's not too late. In my opinion, you should start saving 10% of your paycheck. If you can't swing that, try 5%. If you can only put aside $25 from each paycheck, do it. But start putting something away.
That's right. Any amount you save on a regular basis will grow. If you can save more, it will grow faster.
That's exactly right, Ryan.
And if you pay off a debt, divert the payments you were making to savings. You're used to not having that money already, so save it up.
That's a great point, Ryan. Before we sign off, let's talk about a type of savings account that's a little more fun.
Sure. You're talking about vacation accounts, aren't you?
I sure am. Investopedia wrote an article about the 3 best places for a vacation account.
Great. What does that article say?
First, it notes it's a good idea to save up for a vacation rather than pay the bills down afterwards.
Well, yeah, opening a big credit card bill after vacation is a bit of a buzzkill.
It also suggests having an automatic deposit each month for a vacation fund.
That's another good idea. Set it and forget it.
Absolutely. The article also suggests putting your savings into some kind of interest-bearing account like we mentioned before.
Sure, I like that idea. You earn interest on the money you save and you have more to spend on your trip.
Absolutely. And as the article puts it, it can help you get additional travel experiences. If you earn 5% interest on a $3,000 savings account, that's an extra $150.
Sure, that could cover a nice dinner or a couple of tickets for the 2-hour house tour at Taliesin.
And that's a great example. The money you earn via interest could easily pay for tickets at Frank Lloyd Wright's estate. A tour of the iconic Wisconsin landmark would enhance anyone's vacation, I think.
All right, so where should people put their money so they can start earning additional travel experiences?
Well, first, the article again recommends a high-yield savings account.
That's not just any savings account, is it?
Great question, Ryan. No, it's not. A savings account that pays less than 0.5% interest is not a high-yield savings account.
That is the national average for saving accounts, though, isn't it?
It is, and that's why you want to look for a savings account that offers an APY that's higher than that.
Got it. So what's next?
Well, a high-yield checking account is another great option for growing your vacation cash. You can also put money in a short-term certificate of deposit or CD.
Oh, I like that idea. Say I'm going to Berlin 3 months from now. I can open a 3-month CD and put money in that. And maybe by the time I board my flight, I'll have all the cash I need for meals and any incidentals in my CD. I'll be able to enjoy my trip without having to worry about how much I'm spending.
That's right. And with that, I think we're out of time. Viewers, if you have questions about your emergency savings or your overall financial strategy, contact us today at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your current retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV or radio show, or you can schedule that complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.